For film buffs and financiers alike, Michael Burry's fame has made his name common parlance. Michael Burry is an American hedge fund manager and investor. He became well known for betting against the real estate market during the 2008 financial crisis, a move that made him and his investors very wealthy. In truth, this tale was told in The Big Short, a film adapted from Michael Lewis's book. Since 2020, Burry has been an outspoken critic of Tesla, forecasting that the company's stock price will continue to plummet along with those of other electric vehicle makers. The fact that Tesla has also felt the effects lends credence to Burry's forecasts. But Burry predicts Tesla shares will fall another 70%. Where does Burry get his information? Speculation. Will Tesla's stock fall? I'm curious as to the consensus of opinion among specialists. So, let's find out. Hedge fund manager, value investor, computer scientist, and resident of the United States, Dr. Michael Burry. He founded and managed the hedge fund Sign Capital LLC, which made billions for its investors during the great financial crisis of 2008. Burry established Sign Capital LLC in 2001 because, to Burry's keen investment strategy with Sign, the fund returned 55% in its first year, and by 2004 he was managing $600 million in assets, making him a notable figure in the world of finance. In 2020, Michael Burry took a stand and publicly bet against Tesla shares, calling it a bubble on the verge of bursting. Later, he claimed that Elon Musk had sold Tesla stock for the sole purpose of making a profit, rather than to satisfy tax authorities or regulators. Just wait a sec, and we'll revisit this topic. Investors banking on a gain in Tesla's stock price in 2022 were dealt a stinging blow on February 25, when the stock plunged by more than 35% to $870.07. Certainly, the cloud cast by the unfolding situation in Ukraine and the imposition of sanctions against Russia are factoring into this slump. In addition, the future seems bleak for the tech sector as a whole, and the electric vehicle sector in particular. There are, however, a number of Tesla-specific issues that could be fueling market dissatisfaction. Its chief executive officer is in the midst of a protracted legal dispute with the Securities and Exchange Commission, SEC, over a deal from 2018. Michael Burry warned that uninformed investors who put money into meme stocks and cryptocurrencies are setting themselves up for catastrophic losses. Can Tesla really decline 8,090% since 2000? He asked on Twitter. That's what a lot of successful people said they did. Amazon's stock price dropped by 95% 20 years ago, but the company was able to rebound by completely restructuring its business. Burry argues that FOMO, the fear of missing out, has caused asset prices to rise to unsustainable levels. He warned that parabolas based on FOMO won't have a horizontal resolution. Burry initially justified his decision to short Tesla by comparing the company's price to the real estate bubble, but later asking the public to abandon the hashtag. Now that Tesla has blown its own trumpet, the good doctor says Tesla stock may fall as much as 90% this year without causing any irreparable damage. He tweeted that a drop in Tesla stock price below $100 by the end of the year would not cause a system crash. No introspection occurs. However, this would spell the end of a once promising investment strategy. Under the alias Cassandra, a reference to the Greek mythological figure who was destined to make accurate predictions but was never believed, Boris told his doubters, "Well, my last Big Short got bigger and bigger and bigger too." Take advantage of Tesla's $60 billion market cap boost on just this one day. This tweet was made by Burry in regard to the $750 million he won for investors at Sign Asset Management by betting against the U.S. housing market and the $100,000 he took for himself. Given that Tesla shares were trading for around $95 at the beginning of 2020, Burry's claims seem to have some merit. By February of this year, Elon Musk was widely recognized as the world's wealthiest person thanks to the 826% increase in Tesla's share price. However, it has come to light that Michael Burry has, at least temporarily, given up some of his most outrageous shorts. A wager against Cathie Wood's flagship ARK Innovation exchange-traded fund. Among the transactions was Tesla Incorporated, led by Elon Musk, and the shares 20-plus year Treasury bond ETF, the largest Treasury exchange traded fund. Due to incomplete information about the company's bearish put options, it was forced to shut down in the third quarter. The outcomes of the bets are unclear. Burry informed CNBC last month that he had ended his Tesla wager, claiming it had been nothing more than a trade all along. Does he now disagree that Tesla's stock price will decline? Stock market speculation, according to Burry in a recent interview, has reached a crucial stage not seen since the 1929 calamity, and assets are more overpriced now than they were before the dot-com bubble burst. He is concerned that the current geopolitical and economic instability will be even more severe than that of the 1970s. His main worry seems to be that the government agencies tasked with preventing economic collapse, such as the SEC and the Federal Reserve, aren't doing enough. In addition to his persistent Twitter stalking and shadiness of Tesla CEO Elon Musk, Burry has been unloading his stock. In the third quarter of 2021, he sold $137 million worth of common shares, leaving him with $42 million. Tesla's situation has not been looking bright as of late. The German factory where it will be manufactured has not yet opened. The grand opening has been pushed back more than once. The facility is vital to Tesla's plans for growth and expansion in Europe. It has been postponed until at least the first quarter of 2023 before the company begins manufacturing its intended electric pickup truck. This event, which had been planned for late 2022, has been delayed. There may not be a more talked about firm on Wall Street, with as many divergent forecasts for its future, as Tesla Incorporated, a few of financial firms, have predicted that the electric vehicle market leader will reach $1,400 in the future year in a single editorial. Despite his firm's recent increase in its price objective on Tesla shares, J.P. Morgan analyst Ryan Brinkman forecasts a dip in Tesla shares to $325. In a recent note, he explained that factors like the company's novel business model, its enticing product offering, and its cutting-edge technology were factored into the pricing. He went on to praise the company's products, praising their uniqueness, quality, and fun-to-drive nature. The company has strong leadership with a clear vision, and the management staff backs them up well. However, Brinkman brought out several difficulties that affect how much he values the organization. While the risks associated with the technology and the execution appear to be considerably less than previously feared, the risks associated with the demand, execution, and competition associated with expanding into higher volume, lower price points appear to be higher. Given the company's history of empty promises, this is a compelling argument. This is not to downplay the significance of the innovative electric vehicles and solutions developed by Tesla and Musk. Rather, the point is to stress how unrealistically optimistic product release dates typically are. Even though Tesla is the first automaker in over half a century to build itself from the bottom up for mass production, it still has a long way to go before it can release products like the Cybertruck on time. However, there are many who argue that investors should not be concerned because recent developments may actually benefit growth stocks. While rising interest rates may be a cause for anxiety among investors, some market watchers have claimed that Tesla stock is resilient enough to withstand a market downturn. Contrary to popular thinking, Investor Place analyst Luke Longo predicts growth stocks will climb in 2022. His notion is clearly relevant to Tesla's work. He uses the start of the first continuous cycle of rate hikes by the Federal Reserve in December 2016 to illustrate his point. There were 8 rate hikes made by the Federal Reserve over the next 2 years. The value of growth stocks exploded during this time. Since its debut, Cathie Wood's flagship ARK Innovation Exchange Traded Fund, which invests in the market's most dynamic startups, has increased in value by 90%. A new rate hike cycle is widely expected to begin in 2022, therefore growth stocks underperformed severely in 2021. When the rate hike cycle finally begins, though, growth stocks often shake off their slumber and soar to new heights. Despite the belief that growth stocks will suffer during 2022's rate hike cycle, purchasing such stocks now may be your best bet. We're not sure we agree with Burry on this. If past performance is any indication, 2022 should be a banner year. After the stock falls to a certain point, we think it will start rising again and possibly even expand at a faster rate. Do you agree with Burry's forecasts? Do you think Tesla's stock price will fall or rise? Leave a comment below.